Stock market in crisis. China Securities Chairman shocked by market volatility. Apollo.com. Tang Ning reports that Wu Qing, chairman of the China Securities Regulatory Commission, held a symposium on October 20th, asking the experts and financial media present to tell the story of the Chinese economy and the Chinese capital market with political nature. Wu Qing said that we should cherish and protect the current good momentum, further stabilize expectations, and strengthen confidence, a common type of propaganda in the Chinese Communist Party government. Wu Qing mentioned that the world today is undergoing a major change that has not been seen in a century. The Communist Party of China is in a critical period of moving towards Chinese-style modernization, and the capital market is also in a critical stage of transforming to high-quality development. He asked experts, scholars, and financial media to tell the story of the Chinese economy and the Chinese capital market with political nature, people-oriented, party spirit, and professionalism as the standards, and convey confidence and positive energy. Prior to this press conference earlier this month, the press conferences of the Ministry of Finance and the National Development and Reform Commission of the Communist Party of China lacked expenditure details, causing violent fluctuations in the market and panic among many investors. Recently, China's stock market has been fluctuating like a pendulum. On October 18th, the CCP's real estate-themed press conference failed to boost the market as investors expected, causing China's stock market to plummet. The CSI 300 index closed down 1.1% on Thursday, about 11% below its high on October 8th. China's 200 million retail investors, who rushed into the bull market, soon found that the stock market plummeted and were forced to retreat in a hurry. Chinese netizens wrote, "The Chinese stock market is not fear, but mental terrorism." Ling Wei-Cern, managing director of Union Bancaire Privée, a Swiss private bank focusing on private banking and asset management, said, "Stock market investors are looking for major data that can further push up the stock market, while the CCP government is more concerned about how to gradually restore the economy and the property market to health. As long as this expectation does not match, all press conferences will inevitably disappoint." On October 9th, as the benchmark index recorded its worst performance since 2020, the phrase "closed securities accounts" appeared 56 million times on the social media platform WeChat, while in the previous few weeks, the phrase was used less than 10 million times a day. Yardeni Research, a well-known independent investment research company in the United States, pointed out in a briefing on the 17th, investors no longer seem to believe that the stimulus measures of the Chinese government can solve economic problems. The rapid rebound of the Chinese stock market now looks weak. Data shows that ETFs investing in Chinese stocks have performed poorly recently. According to data from FactSet, the iShares MSCI China ETF fell 5.6% this week, then rebounded and fell 7.7% last week. Yardeni Research's briefing pointed out, apart from the many risks of doing business in China, future earnings expectations have remained basically flat over the past 15 years. Since 2022, corporate earnings have continued to disappoint. Yardeni Research also pointed out, it is relatively easy to falsify national growth data with local government projects, but corporate earnings are more difficult to falsify. Yardeni Research pointed out that the total amount of outstanding bank loans of the Chinese Communist Party is close to $36 trillion, about 3 times that of the United States. China's consumer confidence has collapsed, and rising stock prices alone are not enough to stimulate consumption. Because stimulating a country that is heavily indebted due to the collapse of the real estate bubble through loose financing conditions may not be the best solution. Consumers and companies need time to rebuild their balance sheets and restore confidence in borrowing after deleveraging. China's poor economy boosts the gray market, making things worse for luxury companies. China's second-hand and gray luxury goods market is growing rapidly. As China's economy has been sluggish for a long time and unable to recover, while luxury brands are rising in price, some consumers are turning to cheaper purchasing channels. But this has made things worse for luxury companies such as LVMH, which are facing challenges in operating in China. LVMH, the world's largest luxury group, reported last week that its quarterly sales fell 3%, the first quarterly sales decline since the outbreak. Affected by slowing demand in China, Italian fashion brand Salvatore Ferragamo also reported a decline in quarterly revenue. According to Reuters, Max Pirro, CEO of Rehub, an intelligence consulting firm that tracks gray market transactions for luxury goods, said, "In China, as long as there is a price gap, the price gap between China and other countries, there will be price-sensitive consumers turning to the gray market." The gray market is estimated to be worth $57 billion a year and has grown in recent years due to the rise of platforms such as the fashion app Daewoo. Luxury goods on these platforms are often sourced from overseas and are priced 20% to more than 50% lower than those sold in flagship stores in China. At a Burberry store in central Shanghai, the brand's iconic checkered scarf costs 4,800 RMB, $678, according to the Financial Times. On the fashion app Daewoo, it costs just 2,939 RMB. The Burberry store, located in one of Shanghai's most upscale luxury shopping malls, sells a Coach jacket for 4,400 RMB and a Prada hat for 6,150 RMB. The prices for these two products on Daewoo are 3,499 RMB and 4,939 RMB, respectively. Rehub estimates that sales of 48 brands on Daewoo grew 19% year-on-year in the second quarter to more than 7 billion RMB, 984.4 million. Retail sales in China grew 3.2% in September. Weak retail sales, an indicator of consumption, are bad news for global luxury giants, as China accounts for about 25% of the industry's global revenue. Growing consumer interest in the secondhand and gray markets spells trouble for high-end brands seeking to maintain sales in China as global inflation persists. The rise in luxury brand prices is definitely one of the reasons why more and more consumers are turning to the secondary market. Yi Keiji, a 28-year-old market content manager and luxury consumer, told Reuters. Oversupply of secondhand after LVMH reported third-quarter sales, company executives insisted on continuing to push products from brands such as Louis Vuitton and Dior upmarket, saying they had no plans to launch new, more affordable lines. They also said they kept a tight rein on brand distribution and had no intention of entering the secondhand market. But China's slowing economy has also fueled the secondhand market, as more people look to cash in on their luxury collections as cash becomes tighter. The number of sellers has grown very fast, most of whom are selling luxury goods for the first time, said Zhu Tainiki, founder of secondhand luxury goods marketplace, Zur. But for buyers, the market is relatively stable. This has led to a drop in average purchase prices from last year and a drop in average order value of about 10%. Despite this, brands such as Louis Vuitton and Coach are still selling fast, Zhu added. China's secondhand luxury goods market, including platforms such as Plum, Zir, and Alibaba's Yanyu, has grown at a compound annual growth rate of more than 30% since 2020, according to estimates by consulting firm iResearch.